How medieval merchants invented modern banking by accident. Right now, you can move money anywhere on Earth in seconds. You can send it to a stranger in another country, borrow against future income you haven't earned yet, and keep your savings in an institution that is simultaneously lending most of them to someone else. You interact with systems this complex every time you tap a card or check a bank balance, and you probably don't think about any of it. What you almost certainly haven't thought about is that none of these systems were designed. Not one of them started as a plan. Every single tool that modern banking runs on, the loan, the letter of credit, the checking account, the concept of interest, the deposit, the transfer, was invented by medieval merchants trying to solve an immediate practical problem. Not by economists, not by governments, not by anyone with a theory of finance in their head. By traders hauling goods across dangerous roads who needed a better way to move value without getting robbed. And almost every time they solved one problem, they accidentally created a tool that would reshape the economy of the entire world. Let's start with the problem that started everything. You are a merchant in 13th century Italy. You buy cloth in Florence and want to sell it at the great trade fairs in Champagne, in northern France. The route is several weeks of travel across the Alps, and you have a problem that would seem obvious the moment you thought about it even once. You need gold to buy goods at the fair, but if you carry gold across the Alps, there is a very good chance you will be robbed. Bandits on mountain roads were not a minor inconvenience in medieval Europe. They were a predictable, professional, and persistent feature of long-distance trade. Losing your gold meant losing your entire investment. It might mean losing your life. Carrying gold was how merchants got killed. So the Italian merchants, the Lombards and the Florentines and the Venetians did what practical people always do when faced with a dangerous, recurring problem. They found a workaround. The workaround they found is so elegant and so foundational to everything that came after it that it deserves a moment of proper attention. The system worked like this. Before leaving Florence, a merchant would deposit gold with a local money changer. In exchange, the money changer gave the merchant a piece of paper, a letter written in a specific legal format that said, "The bearer of this document has deposited X amount of gold with us in Florence and is entitled to collect the equivalent value in the local currency at our partner office in Champagne." The merchant then traveled to France with a piece of paper instead of a chest of gold. Nobody robs you for a piece of paper. At the fair, they presented the letter to a corresponding money changer who was part of the same network, collected their funds, and did their business. This instrument was called a bill of exchange. It was, in practical terms, the first bank transfer, and it solved the robbery problem perfectly. But here is where it gets interesting, because bills of exchange solved more than just the robbery problem. They also quietly solved another problem that nobody had named yet. Medieval Europe had a chaotic currency situation. Florence had the florin. Venice had the ducat. France had the livre. England had the pound sterling. Each region had its own coins, and the exchange rate between them fluctuated constantly, and making a transaction across currencies was genuinely complicated. A bill of exchange handled this automatically. When you deposited florins in Florence and collected livres in Champagne, the correspondent network had already done the currency conversion at the agreed rate. Merchants were now moving money across currencies and borders with a single piece of paper. The bill of exchange was not just a security tool. It was the prototype of the international wire transfer, invented because a merchant didn't want to get stabbed on an alpine pass. And then something even more interesting happened. Merchants started trading the bills of exchange themselves. If I hold a bill promising me payment in Champagne in 60 days, and you need cash today, I might sell you that bill at a slight discount. You pay me less than its face value now, you collect the full amount in 60 days, and the difference is your profit for waiting. This is a credit market. Merchants had accidentally invented it while trying to solve a cash flow problem, with no awareness that they were building a financial instrument that entire industries would eventually depend on. The bill of exchange had become negotiable. Value could now move not just across space but across time. You could effectively borrow against a future payment that hadn't arrived yet, and the system self-organized a market for doing exactly that with no central designer and no government involvement. While all of this was happening in northern Italy, another group was solving a parallel problem from a completely different direction. The Knights Templar were a military religious order founded in the 12th century to protect Christian pilgrims traveling to Jerusalem. Protecting pilgrims meant they had a similar problem to the Italian merchants, people making long, dangerous journeys who needed to carry money and couldn't do it safely. The Templars had a network of fortified houses across Europe and the Middle East, and they used that network to offer essentially the same service the Italian merchants were developing independently. A pilgrim deposited funds at a Templar house in France, received a document, and could withdraw equivalent funds at a Templar house in Jerusalem. The Knights Templar, a military religious order whose primary purpose was fighting, had become bankers essentially by accident, because their infrastructure was exactly what the banking problem required. A trusted institution with offices on both ends of a dangerous journey. By the time the great Italian banking families arrived fully on the scene, the Bardi, the Peruzzi, and eventually the Medici, the basic infrastructure was already there. What the Italians added was scale, sophistication, and an accounting innovation that quietly became one of the most important inventions in economic history. Double-entry bookkeeping. Before double-entry accounting, keeping track of money was genuinely difficult and genuinely unreliable. Single-entry systems could be manipulated, contained errors that compounded over time, and made it nearly impossible to get a clear picture of a business's actual financial position at any given moment. Double-entry recording, logging every transaction as both a debit in one account and a credit in another, so the books always had to balance, changed everything. It made large-scale coordinated finance possible in a way it hadn't been before. The Medici Bank in the 15th century operated branches across Europe and managed the finances of popes and kings, and the mechanism that made this possible was the double-entry ledger. Every loan, every deposit, every currency exchange was recorded in a way that could be audited, verified, and used as the basis for further transactions. Bookkeeping wasn't a clerical detail. It was the foundation that made complex finance trustworthy enough to scale. And scaling created the next accidental invention. Here is what happened when banks started taking deposits from large numbers of people at the same time. They noticed something. Not all depositors wanted their money back at the same time. Most money sitting in a bank vault was just sitting there, idle, while the bank kept it safe for depositors who weren't using it. And those idle funds were an opportunity. If a banker lent out a portion of the deposits held in trust, carefully enough that they could still meet any individual depositor who came to withdraw, they could earn interest on the loans while still fulfilling their function as a safekeeper of deposits. They were creating money that didn't physically exist in their vault, because the depositor believed it was there and the borrower was using it simultaneously. This is fractional reserve banking, the practice that underlies how every modern bank in the world operates. No one sat down and designed it. It emerged from the logical conclusion of having deposits and lending capacity in the same institution at the same time. The church noticed this and didn't like it. The theological objection to interest-bearing loans had a specific name, usury, and it was considered a sin. You were not supposed to charge someone for the use of money, because money itself was supposed to be inert. You weren't creating value by lending it, you were just exploiting someone's need. But the prohibition created a pressure the market couldn't ignore. Merchants needed credit to fund long journeys and large purchases. Customers needed loans to survive bad harvests. The demand for lending was enormous, and the church's prohibition didn't make that demand disappear. It just made the finance more creative. The Italian merchants solved this problem with a sophistication that would be admirable if it weren't also somewhat brazen. Bills of exchange, technically, didn't charge interest. They charged a currency exchange fee. The difference in value between what was deposited in Florence and what was collected in Champagne was framed as the cost of the conversion, not the cost of the loan. The profit was real, the loan was real, but the legal structure avoided the word usury. Medieval bankers were not just financial innovators. They were also some of history's most creative lawyers. What emerged from all of this cumulatively, over roughly 3 centuries of merchants solving immediate practical problems, was the complete toolkit of modern finance. The bill of exchange became the check, the wire transfer, the letter of credit. The negotiable instrument became the bond market. The deposit and loan model became fractional reserve banking. The double entry ledger became the accounting standard that every corporation on Earth uses today. The currency exchange networks became the foreign exchange market. None of these things were invented by people trying to invent them. They were invented by people trying to get paid after a long journey without being robbed on the way. So here's the full picture. A merchant who didn't want to carry gold over the Alps invented the bank transfer. Pilgrims who needed to reach Jerusalem safely stumbled into an institution that looked exactly like a bank. Bankers who noticed idle deposits were an opportunity accidentally created fractional reserve lending. Accountants trying to catch errors in their ledgers built the foundation of modern corporate finance. And all of them, trying to navigate the church's prohibition on charging interest, invented the legal structures that financial instruments still use today to obscure what they're actually doing. The entire architecture of global finance is an accumulation of workarounds, each solving a specific and immediate problem, none of them imagined as anything more than that at the time. And now look at you. You walk into a bank or open an app and interact with a system so seamlessly integrated into your life that it's invisible. The check you write is a direct descendant of a 13th century bill of exchange. The interest rate on your loan is the direct descendant of a currency conversion fee designed to avoid a sin. The savings account that holds your money while the bank lends most of it to someone else is the direct descendant of a Florentine merchant noticing that his vault was full of gold nobody was currently using. You are living inside a system built entirely by accident, by practical people solving immediate problems, who had no idea they were building the financial architecture of the modern world. The accident just happened to work. And it worked so well that in 700 years, nobody has felt the need to start over.